This is Real Estate This Week with Stephen Gasque. 17 years on air and online, helping you succeed in buying, selling, and investing in property. The best real estate strategies out there, just for you.
Welcome to Real Estate This Week. Hi again, I'm Stephen Gasque, and I'm delighted you're here as we look at the summer market, all about what you need to know if you're buying a home, selling a home, or both in the next 3 months. And for that, let's talk to an expert who follows the nation's real estate markets every hour of every day. Joining us now is Selma Hepp, Senior Vice President and Chief Economist at Cotality, formerly known as CoreLogic. Cotality tracks real-time trends in the nation's real estate, mortgage, and insurance markets. Selma, welcome to Real Estate This Week.
Thank you so much for having me. It's such a pleasure to be here with you and reconnect after some time, some years.
I am so glad to be talking to you. And so, Selma, let me ask you this. As we enter the summer market of 2026, what's your headline? What's happening in real estate in America?
Well, the real estate market remains rather subdued in terms of housing market transactions, meaning how many home sales we have out there. Although what's encouraging to me is that despite the spike in mortgage rate that we saw following the Middle Eastern conflict and spike in oil prices that result in a short shock for potential home buyers, but we do see home buyers sort of rethinking, and those that have been ready for a while starting to come off the sidelines. So it is not a super exciting housing market like it was a few years ago, but by the same token, it's not overly competitive. So for those folks that are interested in coming in, there's less competition, so less bidding wars, for example, and more inventory. And that's a different environment than it was a few years ago. And that to me is very encouraging when I think about what the market outlook is going forward.
I see. Interesting, because it sounds to me as though you're saying that buyers have some things in their favor, like more homes for sale, and some things that are not in their favor, like mortgage interest rates rising. And so this is causing buyers to sort of think more carefully before they jump in?
Yeah, I think so. When we look at, as traditional economists, when we look at these indicators that give us a sense of what's going on in the housing market, what we do see is that it takes longer for home to sell, so days on market are longer. There is less price bidding, meaning home selling over the asking price. There is longer time from when the home is put in a contract to when the actual closing is, because there's a lot of negotiation that goes in during that time. And the inventory itself has been building up over the last couple of years. That just suggests that buyers are, yes, they're aware there is inventory, but they're not jumping in at the same rate they were used to.
So if I'm interested in buying a house in the summer of 2026, and I see that mortgage interest rates are not really that good anymore, should I wait? Do you expect a drop anytime soon, or should I just accept it and move forward with the rates I see?
Yeah, unfortunately, at this point, we are in the rate environment that is suggestive of higher for longer, and I'm sure a lot of consumers have heard of that expression, but we no longer expect mortgage rates to come significantly below 6%. They may touch below 6% at times, but as they did in early March this year or late February this year. But overall, we have a lot of risks that are driving overall borrowing rates higher, including mortgage rates. And so it's a very dangerous game to say, okay, you should wait, which, a lot of people have been doing for the last couple of years, because the message was mortgage rates will come down, mortgage rates will come down. Well, now knowing that mortgages are not likely to come down more than, maybe 10, 20 basis points, and home prices continue to increase at very slow but steady pace. I mean, they're still up on a year-over-year basis. It's as good time as any, in my opinion. And if I was a potential buyer right now, I would be looking at the market, because I think the opportunity now is not so much where mortgage rates are. It's more in the fact that there is inventory, demand is low, so you can negotiate better. You can get a better deal. Sellers who do need to sell, and we have to remember that not all sellers need to sell. They may be testing the market and then deciding not to sell if they don't get the price they want. But if they do need to sell, they're more willing to negotiate. So again, I think one should not focus anymore on where mortgage rates are, what's going to happen with mortgage rates, but more like, can I afford this home? If I buy it today, in a year from now, 2 years from now, and take into consideration that property taxes and insurance are going up, only portion of the mortgage payment that's fixed is principal and interest, right? If you take all of those things in consideration, and you calculate and you say, okay, I'm still comfortable, then I would say that's the most important consideration.
Well, Selma, that makes a lot of sense. And it reminds me of that old saying in real estate, which is, it's better to buy real estate and wait than to wait to buy real estate.
Well, that's certainly been the case. If you take out of the consideration the period of great financial crisis, which was very special time, and we don't have, for example, those mortgage products that we did back then that led to the surge in home prices, it's been generally the case that home prices have been on a steady rise historically.
Right, right. And if you think about what you just said also, if you go in and you buy a house and you just say, okay, I've got a deal with mortgage interest rates, and then I get the house, at least if mortgage interest rates go up, then I'm still in a good position. Plus, every year, chances are the home will appreciate somewhat in value and your equity will grow.
Exactly. And one beautiful thing about the US mortgage system is that you're actually not locked into your 30-year fixed rate mortgage. You can always refi. And if down the road, a year or two from now, mortgage rates are lower, you can refi. And so you're really not necessarily stuck in a sense with this current mortgage rates if things get better.
Absolutely. Now, let's turn now, Selma, to sellers in the summer market. I know a lot of people remember the days where they just put a for sale sign in front of their house and bam, it gets sold within hours. That's not happening anymore. And as you said earlier, sellers are having to negotiate more. Tell us about sellers this summer.
Yeah, sellers are certainly getting that message that I can no longer just put it up and expect to get the price that I want. So sellers are more careful in terms of pricing. There is a lot of price discovery going on at the moment, meaning like I put my home up for a sale and maybe I don't get that price. I take it off the market. I relist it at a different price, or I lower the price in the process. So we do see that going on. And then what we also see is sellers being more willing to provide concessions, whether that be help with closing costs or help with inspection, or help with repairs. And so the biggest problem for buyers when it comes to sellers' expectations is that a lot of sellers don't necessarily have to sell. And so if they don't have to sell, they may be willing to wait it out longer to get the price they were expecting, or maybe change their mind even about selling that home. So most recently, in more recent data, I mentioned how inventory has been building up over the last couple of years, but what we have seen this spring home buying season, it could be a function of higher mortgage rates, but also overall uncertainty in the economy and geopolitically, is that fewer sellers are actually listing their home this year than last year. So we are not likely to see as much of an increase in inventory going forward as we have up until this point.
And so, Selma, it does make sense that with all the volatility in the world, with the markets going up and going down, And people wondering what's going to happen, I guess a lot of people might be waiting not only to put their homes on the market, but also to pursue their dream of buying a house.
Yeah, I think that's been the case for a couple of years now because not inconsequential, but home prices cumulatively are up nationally like about 50% from the onset of the pandemic. In some markets, they're up as much as 90%, meaning that they doubled from where they were pre-pandemic. So the equation of, the calculation of affordability has changed significantly. The typical mortgage payment, even if you adjust for recent inflation that we've had over the last few years, it's up 63%, meaning that,
Wow.
if I bought my house in 2019 and I will buy the same house now today, I will have to pay 63% higher, just mortgage and principal and interest today than back then. A median priced home. This is not even like higher price home. This is a median price home. So, the equation has changed significantly for buyers. And in the process, you're looking at having to come up with much higher down payment, which is excluding a lot of first-time home buyers. You have a lot of competition still generally in the market where there's not a lot of inventory, simply by the fact that there's not a lot of inventory. You don't have to have a lot of competition. You can have just few buyers, but when inventory is really low, it creates competition. So I can understand where people would find it a little bit more discouraging now to think about buying a home than a few years back.
I see. And now a big question for you, Selma, because you are an economist who follows real estate all across the United States every single hour of every single day. Have the real estate markets across America moved from a solid seller's market into a balanced market, or in some cases, a buyer's market, or are they still pretty much a seller's market?
I would say one important caveat here is that we have to always remember that local markets are local. There is no national housing story anymore. And all of these indicators differ very much depending where you're in the country. So in some markets, I would say you do have more of a buyer's market. In other markets, I would say you still are in a very deep seller's market. And in some markets, there is a bit more balance. It really depends where you are. And the reason why these differences exist is because coming out of the pandemic, we have had quite a bit of variation in the number of new homes being constructed, how much new construction was happening. And so in the markets where you have a lot of new construction, in markets where there's been potentially a lot of second homes or investor purchases in recent years, and now those folks have decided to sell that second home or investment, you have more inventory. That makes that market more of a buyer's market because the buyer has an upper hand.
Mm-hmm. Mm-hmm.
In markets where there hasn't been a lot of new construction, or where generally we haven't seen a lot of population growth, or because it's really population growth and job growth that drives sort of investor activity, how investors are impacting housing market. But in some markets, yes, there is a lot of investor activity. In some markets, maybe not so much. And when I'm talking about investor, I'm talking about all sizes of investors, because really the majority of investors are actually mom and pop. They're not these institutional investors that we're all worried about. They're more mom and pop. But mom and pop investors are going to be buying in areas where inventory is either significantly under supply, or there's going to be a population demand, constant population demand, because there is in migration from other states or large job growth, right?
Mm-hmm. Mm-hmm.
The point is that all of these things affect where each of this local market is at the moment. So in some, you'll definitely have buyers with an upper hand. In some, you won't.
I see. I see. And so, Selma, let me leave you with two big questions, one for buyers and one for sellers in the summer of 2026. Just to sum it up now, if someone were to ask you, Selma, as a real estate economist, Is this a good time to buy a house? What would you tell that person?
I would say that it's as good as any in the near future. I think that there's a lot of pent up demand. So if you're a potential buyer out there, there are many of you. And when there is a point in time when we have lower mortgage rates, I think that competition is going to intensify. And then it becomes harder to get what you want at the price you want. Home prices, by most estimates, are not going to go down. So, I know we all want to wait for that moment when home prices start declining. And a lot of times, potential buyers, that's what they say: I'm just going to wait until home prices come down. Well, history has shown us that that's very rarely the case. Maybe in some local markets, yes. Maybe if you're buying in west coast of Florida, maybe if you're buying in parts of Texas, home prices have come down. But for the majority of other areas, they have not, and they're forecasted to go up going forward. So home prices will be higher. Mortgage rates are not likely to move much. That's why I think now is as good time as any in terms of where we are currently in housing market environment.
I see. And now the same question about sellers. Selma, if someone were to come to you and say, you are a real estate economist, is this a good time to sell my house? What would you tell that person, Selma?
I think for sellers, there's a hard realization here. And that's the one that I was mentioning when buying a same home now would cost me 63% more in terms of my typical mortgage payment than it was, 5 years ago or 6 years ago. That's the hard reality for sellers. So for sellers, I would say it really depends on what the reason is that they're selling. Some sellers sell because they're retiring and they want to go live somewhere where it's warm weather and more of a retirement community, or they want to go be closer to the kids. Or sellers usually sell due to number of life events. And so to them, the bigger consideration, I think, is why they need to sell. Is it because they really need to be closer to another family member? And so I think for sellers, it's more about what's most important to them right now versus is it now a good time to sell it?
I see. I see. And speaking of sellers, we have to remember that many sellers, if they've had their house for 5, 6, 7 years, they've made a ton of equity. And so if they sell those homes, they're going to have a pile of money to either reinvest in their next place or just to scale down and have some cash on the side. That's a lot of money.
Absolutely. Unlike previous cycles in the housing, this time around, it all the powers is currently in the hands of homeowners, of existing homeowners. And I say that because out of the $45 trillion valuation of the residential housing market in the US, 35 trillion of that belongs to homeowners themselves, not banks, not lenders, but homeowners themselves. So they have a lot of equity. In our Cotality data, which we track this very carefully, on average, existing homeowner right now that has a mortgage has over $300,000 in equity. That means that they can use that equity towards another home. So it's absolutely right what you say. Homeowners, they have a lot more cash to work with than say either more recent buyers that bought over the last couple of years, or even those that are just trying to enter the housing market right now. So sellers are really in a good position right now compared to any other participant in the housing market.
Oh, Selma, that is such great information. And I really want to thank you for your solid analysis about what's happening as we enter the summer market of 2026 and what it means to anyone interested in buying a home or selling their home. Selma, thank you so much for being on the show.
Thank you so much for having me. It was such a pleasure to talk to you, and I'm here for any questions in the future.
Selma, I'm going to count on you. Thank you so much for joining us on the show.
Thank you. Thank you so much for having me.
You're very welcome. Selma Hepp, Senior Vice President and Chief Economist at Cotality, formerly known as CoreLogic. Cotality tracks real-time trends in the nation's real estate, mortgage, and insurance markets. Next time on Real Estate This Week, as the summer storm season cranks up, a special report on how to toughen up your house against violent weather. That's next on Real Estate This Week. And until then, I'm Stephen Gasque, and thank you for listening.
A brand new episode of Real Estate This Week with Stephen Gasque drops every weekend, everywhere. And you're invited to listen, subscribe, and follow us. Just look for Real Estate This Week with Stephen Gasque. The best real estate strategies out there, just for you.